Cool. I know we only have 20 minutes, so I want to keep it quite tight as well. But thanks, Max, for your introduction to 21 Shares, to what I do at 21 Shares. I feel like maybe we should get you to do these pitches for us instead. But I really appreciate being here. I'm really excited to see what the others have to share, what the audience has to share. And with that being said, let's get kick started. Going to start, with a little bit of a market update. I think it's worth going into what happened over the last year. How did we get to the stage that we're at now and where we can go from here? And then also taking a look at where we might be in the cycle, potential catalysts, and then if we have the time, a sneak peek into our valuation frameworks for crypto assets as well. I think this is also being first is both, very grateful for it, but also a challenge. And I want to make sure to set the stage right so that the others can also have a nice presentation. So with that being said, let's kick off the market update. I think a lot of you, you guys are very interested in the space, so you guys will have already seen a lot of this. But again, it's worth it to just have a look at what happened and where we're at now. As Max mentioned, there was the Bitcoin ETF approval last January or in early January, and this was really a monumental moment for the industry as a whole because it finally gave institutional investors, more traditional investors, and newer investors the opportunity to access crypto exposure without having to directly hold it. And they get the exposure via a regulated investment vehicle. So this propelled Bitcoin to new heights of around 72K at the time. And then came the Bitcoin halving. Some people here believed that the halving would start to balloon the market because it creates this kind of supply shock effect. But this is obviously seen more of a longer time period. This period was also earmarked with a lot of selling pressure from many different angles, which amounted to around $16 billion worth of selling pressure into the open market from, Genesis restructuring, from Mt. Gox, their seized Bitcoin, and also from the German government. And positively here, what we saw is that Bitcoin's price remained fairly stable around 15K, around the 15K margin. So this is unlike in previous years where we would have expected this selling pressure to potentially lead to heavy price drawdowns. So this was quite positive for the industry, and it showed just how much Bitcoin had matured over the years. Shortly after that, and in early November, we got the announcement that Donald Trump had won the U.S. election, and with this also comes a more pro-crypto administration. And in his first week, he's already been quite busy because in the US, we got news of the first ever digital asset executive orders being signed in the US. So this really sets the stage, I think, for further growth in the new year as well. I think I see a comment. Just checking if there's any question. Right, sorry, it's
It was
Vicky.
just me saying that we fixed the problem, but
No
please
problem.
continue.
Of course, I know we have a tight agenda. So yeah, we reached this new all-time high of 109K earlier this year. And of course, it looks bullish, but at the same time, what this meant is some people were wondering, where are we in the market? Have we actually reached a potential cycle top? And to this, I'm going to show you a couple of on-chain indicators, which, if looked at in unison, give us the idea that we're not quite at a market cycle top, but we are entering the latter stage of the bull market. And so in this chart, what you can see is the net unrealized profit and loss. And essentially, what this metric does, it's an on-chain indicator that essentially evaluates how the market is performing, if the market as a whole is in net profit or in net loss, hence the name, of course. And what we can see with this metric is as we enter cycle peaks, the net unrealized profit loss or the NUPL starts reaching more overheated regions. And that's because the market as a whole will be in larger profit. Most of the market will be in profit. And as a result, at this point in time, we see a lot of profit-taking activity as well. And so you can see that that the peak regions, which are like highlighted with blue and green, do coincide with near market tops. So this shows us that there's a lot of profit-taking activity. In the current cycle, it's currently at a green level, so we are reaching the overheated regions, but we haven't quite reached the same levels as in previous bull market tops. So we do expect there to still be room for growth. But of course, given the fact that we are entering the latter stage of the market, we could also expect heightened volatility and potentially a more frothier market. But that's not to say that we don't expect, increasing in prices. If you look historically as well, most of the price action in bull markets come in the latter stage of the market. Another indicator I wanted to show or share with you guys is the total supply held. So I'm going to show both the long-term holder supply and the short-term holder supply. So here we have a chart that shows us the long-term holder supply over a very long period of time. And what we can see, generally speaking, is that as the years go by, we can see that the supply held by long-term holders just tends to increase. And this is a function of a lot more investors being at one or understanding the value proposition of Bitcoin. However, one trend that you also might notice is the fact that when we reach these cycle peaks, such as what we saw in 2017-18, and then as well in 2021, these long-term holders, they tend to sell into strength. They tend to, do some profit-taking activity. I mean, they are also human, and we should also allow them to take profits when the time is right. And in this cycle, we see that this has started to happen yet again. We see that the long-term holder supply is dropping off, and it does give us the feeling that we're entering a potentially more overheated market. With that being said, we can take a look at the short-term holder supply, which helps us also understand more what new what new entrants are doing in the market. And what you can see here is that short-term holder supply has kind of the opposite effect as long-term holders. They tend to buy in when the market is nearing a top. And this is what we see historically as well in 2012, again in 2014-15, and so on and so forth. Right now, that's again picking up. So it does indicate to us that there's more retail investors entering the market or newer investors entering the market. And so we may be nearing a more overheated region. With that being said, I do also think that this year we expect this tick up to go significantly higher than what we saw in 2021. Also because of the fact that crypto has been in the limelight throughout the last 12 months, and there's a lot of new attention in the industry as well. So as a whole, we believe here that we are not yet at a cycle top. We are entering the latter stages of the market, but there is still room for growth here. We did a newsletter on this as well, which is available for free on our website. So feel free to check that out if you want a more holistic overview as well. So given that we're not at a cycle top, I think it's quite important to look at the catalyst. So like what could actually drive this growth? I also got an eye on the clock, so I'm just going to keep things moving along. And the first thing I think is quite important is the fact that we expect a less stringent regulatory environment in the US. I mean, it's only been 1 week that Donald Trump has been president, but to be honest, it already feels like a month in between his meme coin launches and the new executive orders being signed. But overall, I think the message here is that we do expect less stringent regulation. These executive orders are the first step there, but there is a lot of good stuff that we saw in this order as well. Firstly, being that there's an establishment of a president working group for the digital asset industry. This will be chaired by the crypto and AI czar, David Sachs. And what's quite interesting here is that they have 30 days to identify any kind of paperwork regulation that is with regards to the digital asset industry. Then they have half a year to make formal recommendations of what they want to do with each and every regulation. And so I think this is essentially a step for them to take a look at what is the harm that had been done under previous administrations for the industry and an attempt to reverse that. Part of that came at the potential for a national digital asset stockpile. Now, it seems that they didn't want to use the buzzwords that we've been seeing over the last few weeks all over LinkedIn with regards to a Bitcoin strategic reserve. But again, that's something that would take a little longer than just a couple of weeks and months. That has a lot of hula hoops it still has to jump through. But this is very much a step in the right direction and is the first step towards achieving that. On top of this, he mentioned as well, or the executive orders mention the prohibition of CBDCs, which are central bank digital currencies, which we believe is another great step forward because central bank digital currencies would only overextend the power that the central bank already has. Just because it's on blockchain rails would not mean that it is a decentralized asset or that it is a kind of, you know, fleeing from centralization. In fact, this would only increase the grasp that the central bank has over its jurisdictions. And then, of course, the announcement, this wasn't in the executive orders, but this was part of what we saw in the last week as well, is that the SEC have also repealed the Staff Accounting Bulletin 121, which made it very difficult for institutions to custody crypto assets. So all in all, I think the message here being is in the US, we have a new administrative body, and with this, we expect far less stringent regulation. And as a result, we expect the industry to really benefit from this. Moving on, and it's also part related to the previous slide, is that we expect crypto ETPs, exchange traded products, to continue to drive institutional adoption. Now, just to set the stage over what we saw in 2024, the spot Bitcoin ETFs, which launched just over a year ago, have seen just over 120. Sorry, guys, if there's questions, I'll answer them at the end. They're rolling in. I'm happy there's questions, but let me just answer them at the end. Yeah, we expect crypto ETPs to continue to drive adoption. Over the last year, they've had over 120 billion in assets in the US across all spot ETFs, which is a huge amount. This is nearly double, sorry, this is more than double the issuance of new Bitcoin in the same time period. So the kind of demand supply dynamics that you see there is heavily favoring the demand side. In fact, at the end of the year in 2020, December in 2024, we actually saw that Bitcoin ETF AUMs had actually outpaced gold ETF AUMs in the US, which is really significant. But that being said, we expect this to continue to grow, even with all the stuff that I said over what's happened in the last year. We expect this to grow quite significantly. And there's two reasons to that. The first being that these financial products have finally reached a 1 year track record. And for a lot of financial advisors, that is a crucial time period, and that is something that they necessitate before they start advocating these products to their end clients. So we expect this institutional adoption to grow significantly. And then the second being that in late October, I believe, we saw the introduction of options on the Bitcoin ETFs. We already saw some hedge funds pour in with long-only strategies. I think it was around half of the largest US hedge funds. But given that these options will allow for more complex strategies, we expect them to continue to adopt these vehicles. As of now, institutional adoption accounts for just 20%. So we really do expect that to grow next year. And then moving on to the more crypto native side, because I know there's some people probably in the audience keen to hear here as well, and not just about TradFi and the convergence of TradFi and crypto, but there's also two catalysts which I'll talk about, which I think will also propel us in this new year as well. And the first being DeFi. Now, DeFi has been a sector that at 21 shares, we've always been very historically bullish over, particularly in terms of the use case. They finally let you do all the things that the traditional financial industry lets you do, such as lending, such as borrowing, such as taking out loans, or whatever it may be, but via blockchain rails, which is fantastic. However, there's always been one pain point with investing in DeFi, and that's the fact that a lot of these crypto projects, they did not have a very valuable investment case. They were not really utility tokens, and a lot of them only offered governance rights to holders. With the new administration being a lot more, innovation pro or yes. Firstly, a lot of these DeFi projects had been targeted by the SEC with Wells notices, such as Uniswap. And in the new administration, I mean, we see Donald Trump, he has his own DeFi project, World Liberty Financial, which has amassed, I think, 300 plus million in crypto assets. And given the fact that he has his own project and we have a new pro-crypto administration, we expect them to benefit here and start turning on some of these revenue sharing features that will make their tokens far more useful. And this will make the investment case quite different for investing into DeFi projects. And then lastly, is the convergence of blockchain and AI. For my more crypto native group here, you can see Bro over there on the screen. But just to take a step back here, I think blockchain and AI has so much potential. There's many avenues that this, could take. Firstly, being, with potential, I guess, truth searching if things are actually true or not, fake detection, and also kind of the safe sharing of computing resources. But what we've actually seen up until now is this new, I guess, subsector called AI agents. And for those of you not familiar with AI agents, they are essentially AI chatbots like ChatGPT, uh, but without shackles. They have essentially been granted freedom. And so the pain point of AI chatbots before was that it required a lot of human intervention, and they weren't able to do multiple step decision making. AI agents are able to do both of that. And on top of this, thanks to blockchain technology, they're able to transact. And that's really crucial. In traditional industries, this would not be possible because of the stringent KYC requirements. And as of now, a lot of these AI agents, like the guy I have on the screen there, they're a lot more lighthearted and I guess funny iterations of the technology. The AI agent I have on screen there, he's launched his own Spotify album, which is kind of strange to say. And he also has their own NFT collection. And so while this technology, while these iterations have been quite lighthearted, I think it's the case for a lot of crypto innovations over time. We saw this in 2020, 2021 with DeFi or with profile pic NFTs, the same in 2017 with the ICO era. And a lot of these were not the final iteration of what the technology can do, but just the showcasing of what's actually possible. And so blockchain and crypto and AI can take many avenues, but if it's harnessed in the correct way, we do expect this sector to drive significant growth in this bull market, but will also likely be the reason why we reach a potential blow off top. Because the exuberance, the excitedness that we're seeing with this, coupled, of course, with the meme coin activity, means that we have still some room to grow, and these are the reasons why we think so. I believe I'm just over time, so we'll have to leave the crypto asset valuation for another time. I'm sorry we didn't get to this part, but for those of you interested, you can value crypto assets even though you can't feel them, which is a very difficult thing for some people to grasp. And I invite you guys to check this out on our website, all for free, of course.
That's a nice cliffhanger. Thank you very much, Max. I can also just recommend signing up for the 21 Shares research newsletter. That's like, I think on a weekly basis, diving deeper into also these valuation frameworks and the latest like trends and developments on the crypto market. So thanks for the presentation, Max. I think there was one particularly interesting question. If I understand it correctly, and please, Andreas, go jump in if I somehow misinterpret your question. But there was one person asking on for your take on how the executive order and also Trump's push to promote US stablecoins worldwide might also impact MiCA regulations, I guess, in the European market and the stablecoin landscape in the European Union. I think his take was that he is like pushing for global acceptance of US stablecoins. He might also pressure the European Union to maybe be a little bit lighter on non-MiCA compliant stablecoins. Do you have any take on this particular question?
Course, of course. If you know me, I have a take on everything. That doesn't mean it's right, but I do have a take on everything. With that being said, I think your question is kind of twofold, I would say. Firstly, I think on the US side, with the executive order, he made a push for US stable coins, the ones that are legally compliant. And I know that that kind of throws a question as to what's going to happen with Tether. But just off the fact that Tether has so much reserve holdings, I don't expect US Treasury reserve holdings. I don't expect the US to go after the Tether itself. But I do expect, and I think this is what you pointed at in your discussion here as well, is that we will likely see a bigger push for the more regulated stable coins like USDC, which is issued by Circle, to gain in prominence. And that's something we expect both across the US and also across Europe. As we know, MiCA meant that we saw a lot of delistings from stablecoin issuers who are not compliant, which includes Tether's USDT. And I expect this gap to be filled by a US denominated stablecoin, namely USDC, is what I believe. But there's of course the gap still there for any potential, I think, euro-denominated stablecoin as well. It's been heavily swaying towards the US dollar-denominated stablecoin. It's a way that I think they protect their dollar dominance in the digital side as well. So my personal expectation is that USDC will be the leader over here unless they also start issuing some euro-backed stable coin as well.